Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I have a fantastic guest on with me today who is an industry thought leader and one I personally have been looking forward to having on for some time. And this episode could not have come at a better time. Investors are faced with a lot of concerns and worries right now, which makes building an investment portfolio very difficult. Market risks and uncertainties continue to grow. We have concerns and uncertainties about Fed policy. Will the Fed raise, pause, or even cut rates? Seems like we always have geopolitical risks that we have to contend with. We have inflation and oil prices spiking, which is increasing inflationary concerns again. Spiking government debt. And will the US economy fall into a recession or perform a soft landing are just a few concerns and uncertainties that we are contending with today. So with that backdrop, I think you will all enjoy today's guest and learn a lot, as I know I'm going to, and I've been really excited for this very fun and engaging conversation. But first, today's episode is sponsored by the award-winning Zephyr, which helps advisors, wealth managers, financial analysts, and investment professionals make more informed investment decisions. So I'd like to welcome the star of the show, Marc Odo of Swan Global Investments. Marc is a client portfolio manager at Swan Global Investments. Marc is responsible for helping clients and prospects gain a detailed understanding of Swan's defined risk strategy, including how it fits into an overall investment strategy. His responsibilities also include producing most of Swan's thought leadership content, which personally I think is fantastic content. I highly recommend you reading it. Thank you so much for coming on the show, Marc. I have known you for some time, all the way back to when I was working in Seattle using Style Advisor. You'd come and provide us with some amazing insights and facts and different ways of having us tell our story to our clients. And then we were colleagues for a while. So it's really great to have you on the show. I'm really excited for it. So enough from me. Let's move on to the start of the show. Can you start by telling us a bit about yourself that might not be listed in your bio?
Yeah, well, first and foremost, thanks for having me, Ryan. It's great to see you again. And yeah, I would just kind of maybe build on some of the things that you kind of teased there a little bit. Some of the people might remember me, but there was a period when I was at Zephyr from I think it was 2003 to 2014, just over a decade. I was the Zephyr guy, and to this day, people still know me. Sometimes either I'll get on a Zoom call or be at a conference, and people will say, "You look familiar," and I don't think it was from watching Cops. I think it was from something else. I think it was you're the Zephyr guy, weren't you? So yes, that's still I guess I'm the Zephyr guy in emeritus or something like that. I don't know. It was a great time, and I'm really proud of my affiliation with Zephyr.
That's great. I do a podcast. It's called Zephyr Stat Facts, and I start it by saying it's a brainchild of Marc Odo. It is such a fantastic resource. We use them still today, our users, and you have huge shoes to fill. We still meet clients, and they're like, "What's Marc Odo doing today?" And you're still a topic of conversation. And like I said, huge shoes to fill here at
Very
Zephyr.
flattering. Thank you.
So hedging has grown in popularity, especially considering how quickly markets move. They move quicker now than ever before. And the increased accessibility of hedging strategies has increased. Why should financial advisors incorporate hedging strategies into their practices and client portfolios?
Yeah, it's a great question and obviously a very relevant one. I mean, you've already kind of touched on some of the concerns that are out there in the marketplace and the economy. When you think back for the last several decades here, I mean, the primary risk mitigation technique that people have always used is diversification, right? I mean, this whole idea of spreading your eggs amongst multiple baskets is the primary way that people have managed risk. And there's nothing wrong with that. I think that, diversification is a good start, but, there are a couple of drawbacks to it. First of all, what diversification and kind of your traditional modern portfolio theory proposes to do, it's to minimize risk. But what risk is defined as is volatility, right? You say like, well, by diversifying your portfolio, we hope to reduce standard deviation. But a lot of people look at risk as being, well, capital preservation is more important, right? I mean, at Zephyr, we developed the pain index and the pain ratio to say, well, here's another way of looking at risk. And your traditional diversification techniques really aren't focused on capital preservation. And that's where hedging comes in. Now, the second thing I'll say on that, just going to say like why hedging has become so relevant lately, is that at certain times your traditional diversification strategies simply don't work, and we don't have to look back very far in the calendar to figure out what am I talking about here. If you look at 2022, that traditional stock bond model did not deliver the downside protection or risk mitigation that most people had been hoping for. So between the combination of equities and fixed income being down concurrently, people are saying, "Look, I need something else to help complement or augment my risk mitigation picture here."
Mm-hmm. Fantastic. That's a great way to start this conversation because you're right. And then during times of crisis, when you want the most drawdown, or capital preservation and reducing that drawdown risk, during the times of crisis, correlations increase, like what you just mentioned between stocks and bonds. So as you say, everyone is running to the exits, right? And it's important to have other ways to diversify your portfolios, whether that's hedging or other different strategies. Uh, because hedging strategies have become more popular and accessibility has improved, um, the number of strategies have increased out there that financial advisors can choose from. Describe the different equity hedging strategies that are available today and how they might differ.
Yeah, it's a great question. I mean, I wouldn't say that they've just increased. It seems that they've exploded. If you were to go into the various databases and take a look at the number of hedging type strategies that are out there, and a couple of years ago it was measured in the dozens, but these days, literally, it's the hundreds. The first thing I would say is that don't judge a book by its cover. In fact, I was just reading something 10 minutes ago saying that the SEC is really starting to focus on what people use in their names, because there are strategies out there that use the term hedging. And once you pop the hood and look at what these guys are doing, you're like, well, these guys aren't hedging at all. They're using managed futures, or they're doing something entirely different, which probably won't deliver that kind of downside risk mitigation protection. That being said, most of the growth, most of the focus has been in options-based strategies. That's what I believe true hedging is, because as you mentioned, the correlations all tend to spike during periods of crisis. But the one thing that we know that goes up in value when markets go down is put options. And a good hedging strategy uses put options. Now, there's lots of different ways you can use put options, and I'll get into that in just a second here. But certainly, I think a good hedging strategy is composed of not only equity exposure, but then using put options, because they do have that inverse correlation with the underlying investment.
Mhm. It's interesting you brought up, you got to look what's underneath the hood, right? Because the name of a fund can be very it may not be telling the entire story, and we've seen that with ESG funds, right? You've got a lot of asset managers that are trying to ride the coattails of ESG.
Mm-hmm.
They put ESG in the name of the fund, and it's no more sustainable or ESG characteristics than the basic S&P 500.
For sure.
So it's very important across the board to really know what you're investing in, right? Know the investment. So how do advisors, you talked about the different strategies, put options, and there's other strategies out there. How do advisors determine what best type of strategy for their clients? How do they determine what strategy to use?
Yeah, so that's a great question, because there is a whole other layer that of due diligence that was worth having as you start to unpeel the onion here. And a couple things. I mean, I think the first thing is when people use the term options, sometimes people get a little bit skittish about that. Options are still a little bit esoteric or weird. Some people have bad gut reactions to options. And I'll admit, there have been option strategies that have done poorly. I mean, every 5 years or so, you hear about the dreaded blow up. But our philosophy has always been that options are a tool, and it's just how they're used, not if they're used. That really matters. And what makes things a little bit tricky is if you look in the various categories out there, you might see something that says options strategies or options trading. Well, that doesn't really tell you a whole lot, right? I mean, that gives you maybe an indication. I mean, the analogy I like to use is like if I were to tell you, oh, I work for a stock fund. Well, that doesn't really mean anything, right? It's like, well, is it large cap or is it small cap? Is it value or is it growth? Is it international or is it US based? You need more details about how these instruments are being used. So when it comes to options-based strategies, options can be used for hedging purposes, they can be used for income generation, or they can be used for alpha generation purposes. So there's kind of three different ways that option strategies can be used. And I'll be upfront. I mean, that doesn't exactly sync with the way that Morningstar, which is what most people use, their classification system, they don't quite have that same structure. But I would say first and foremost, make sure that if you are looking for an options-based strategy, make sure that they are using put options to hedge. So that's maybe the first or second step. Now, beyond that, I always like to kind of draw analogies to what people are comfortable with or what they already know. And one of the things that people are quite familiar with is this idea of active versus passive management. And obviously that's been the big debate with ETFs, with mutual funds, between the Vanguards and the BlackRocks and everyone else in the world. Are we actively managing or trading these strategies? Well, the same construct or the same philosophy also applies in the hedged equity space. Most of the growth, most of the explosion in both products and AUM that you've seen in the last 5 years or so have been in these buffered products, right? They're what they call defined outcome ETFs or buffered ETFs. And those things have a lot of advantages to them, right? There's lots of pluses there. But there's also some drawbacks too, which maybe we'll really start unpacking here. But the thing you have to know about these buffered strategies is that they are passively managed. What happens is the management will say, okay, we're going to set up a trade. We're going to do it on the first day of the quarter or the first day of the year or whatever. And for most of these buffered strategies, that's the only trade they make for the next 365 days. And that is a good thing and a bad thing. I mean, the good thing is you pretty much know what you're going to get. These buffered strategies say like, okay, we have a certain protection zone that starts at this point. It's going to extend to this point. And as long as the market's in this, if it doesn't fall below that low point, your losses are going to be minimized. Now, of course, there are trade-offs. If the market does go beyond that point, well, then you've got tail risk. There is that black swan risk there because essentially these buffered products are protecting against bear markets, not like black swan events, or maybe even just corrections, not even bear markets. And of course, the other trade-off is to the upside. The buffered products have a cap to them, right? I mean, obviously, put options are not free. You have to pay for the put options. There's always a trade-off. And the trade-off with buffered outcome products is that there is a cap to the upside. If the markets go past a certain break point over that 1 year period, that's an opportunity cost. You're not going to get those gains. You'll get gains up to that point, but not beyond that point. So, a lot to digest there, a lot to unpack, but buffered strategies, yes, they certainly have lots of advantages. And in full disclosure, Swan actually runs buffered strategies for the benefit of the sub-advisory capacity for PACER ETFs. So we have nothing against these passively run strategies, but you could also have actively managed strategies. And that's something else we could talk about too.
Mark, you're exactly right. There is a lot to unpack there. I'm going to take it a step back. You had mentioned, you making sure if you're going into a hedging strategy that that product incorporates put options. Well, how do you know? You mentioned Morningstar. Is that when you look at a database, if you're a financial advisor, you look at a database and you get some information, mostly, quantitative information. How do you go about trying to find out exactly what type of strategy, option strategy, a strategy or a fund is incorporating? Do you have to go to Swan? Do you have to look at more of a fund investment objectives? What's the best way of going about that?
Well, I realize it's not the fun answer, but yeah, you do have to read the prospectus. I mean, you have to go in these things and really read the legalese and put that kind of lawyer hat on and understand what's going on. And certainly looking at different filings and seeing what kind of things that they hold within the portfolio. And they should, a good prospectus will disclose how the options are used. I mean, if it is a buffered product, it will say it's buy and hold. This type of risk return trade-off thing that they're proposing, it's for a 1 year period. And then things might happen in between that 1 year period, which would make the results seem better or worse than maybe anticipated. But yeah, you really do have to do your homework with these things. But I actually think that's kind of a positive, because if you're a financial advisor, if you are a financial analyst who enjoys bringing your own insight and expertise to the equation, helping unpack not just option strategies or hedging strategies, or just like broadly speaking, liquid alternatives, is a value add to the client. Because let's be honest, most of your typical stock or bond portfolios really don't differ that much. I mean, looking at the traditional asset managers, there's not a whole lot that separates large cap value fund A from large cap value fund B. But if you start talking about the liquid alts where people have less expertise, you can, as the advisor or the analyst, bring some insight and an additional layer of due diligence that is, quite frankly, not necessary in most of the traditional funds out there.
Great insight there, Mark. Thank you. And you brought up buffer funds. I'm glad you did, because it's a very popular strategy right now. So a couple of questions. When you had mentioned a buffer fund maybe might have a year time frame. So is that, so if I invest in that or include that into a client portfolio, should it just be for that year? Can you hold it longer than that year? What if you want to sell it? You need to liquidate. The
Sure.
client has some issues. Or is it like, kind of like a CD where you are locked in for a year?
Well, that is one of the great advantages that these buffered ETFs do bring to the table. I mean, if you think about the evolution of this space, what was preceded these types of instruments was the structured note type solutions that are offered by insurance companies or some of the big wirehouses. And those were very illiquid. I mean, if you had a liquidity event that you're describing there, Ryan, it would be very hard to unwind these things, and you would have lots of costs associated with getting out of them. So one of the good news is about the buffered strategies is that, yes, they are liquid. They are in ETF formats. You can buy a ticker. And if you want to hold it beyond that 1 year period, there's nothing you need to do. You just, the management of the fund will update the underlying trade and reset, once a year, they're going to do their reset and push it out to the, next 365 days. But if you do need to liquidate it in between, you can do so. Now, there is a couple of caveats here. One thing is that, when we talk about these caps and these floors, the people who run these things, including ourselves, are always very clear. Like when we say that the cap on this thing is 18%, you're not going to realize that 18% unless you hold it for the 1 year period. If you want to get out halfway through, you can't get all the money and only be in it half the time. It doesn't work that way, right? But the other thing that makes it tricky, and this kind of pivots then to the idea of active management, is that yeah, you might be in a situation where the market's up a lot, and we had set this cap at saying like, okay, the cap on this buffer fund is 15. Well, the market's up 30. Does it still make sense to own that? Well, I mean, you could. Same thing on the downside, right? I mean, if the market blows through its protection levels and all of a sudden you have this left tail risk where the market's going down, does it make sense to just sit there in that? And that's where this whole active versus passive conflict comes into play, because there are shops like Swan, where we as the portfolio managers are still having, the put options, we still have our equity exposure, we're always invested, we're always hedged, but we as the portfolio managers look for points in the market where the market's selling at a low point, and we can essentially cash in our options and rebalance, if you would. Essentially it's this whole sell high, buy low type of concept where we have a put option that's now deep in the money, the market sold off by 25%. Why not rebalance our portfolio by taking advantage of the market dislocation and getting us back to our strategic target? And that's always been a core part of Swan's philosophy. And that's different. I mean, the buffered strategies will just say like, well, look, man, we told you 1 year, it's 1 year. and then you just sit on it. But again, this is a trade-off between active and passive management, and I'd say that there's a role for both. There's advantages of the buffered strategies, there's advantages of this active management strategy that Swan runs. It's a matter of preference.
Yeah, while I prefer active management, I do, doing a bunch of research with Zephyr. You've done similar research, Mark. It's like I don't think it should be one or the other, active or passive, but more inclusive, right? There are definitely some asset classes where it's harder to find alpha, right? Such as large caps. You might be willing, might be better to go passive management there, but we could have a whole conversation on active versus passive um, down the road. One of the hardest decisions when incorporating hedging strategy is determining how much of a client's investment portfolio should be allocated to an equity hedge strategy. Should it be a flat 5%, 10% of the portfolio, or even more? Or should it be based on the size of the allocation to equities? Maybe you've got 70% of your allocation is equity. Should it be a portion of that? So you're hedging that 70% of equities. Is there like best practices there?
Yeah, great question. This is often one that we face too. I would say that certainly it has to be large enough to move the needle. And quite honestly, a 5% allocation is really not going to change your overall
Mhm.
risk profile. I mean, you can use a system like a Style Advisor or some of the other ones out there, and put little 5%, increments in there. And you'll see at the end of the day, the risk return metrics really don't change a whole lot. I mean, we've seen the needle move at 30%. Now,
Wow.
obviously, not everyone gives us 30%, but it's the kind of things like, okay, well, this is the impact it can have on the portfolio. But that also leads to the second question there, which you kind of touched on. It's like, okay, well, where does this come out of, right? Because there are different roles that hedged equity plays, and it's neither fish nor fowl. So historically speaking, what we've seen is primarily like three different types of roles. Sometimes people say like, look, man, especially this was true, prior to 2022, they're saying, I don't like yields on bonds. Duration risk is so high here. I know that there's lots of downside risk in bonds. I need something else to help provide that kind of risk mitigation, capital preservation role that bonds have historically provided. So we do see and still see hedged equity provide that kind of role as a bond surrogate. That being said, you can also use hedged equity as a way to de-risk your portfolio. I mean, if you're like maybe an 80-20 portfolio and you're like, wow, man, I mean, yeah, it's great. The equity markets are up, but I'm not sure how much gas is left in this bull market rally here. Maybe you can kind of keep, a foot in a foot in the bull market and keep a foot in the bear camp by having a hedged equity thing. It's a way to reduce the beta in your portfolio. And the final way that people can use this is just as an alternative, right? People say, "Look, man, I don't know. It's not a fixed income. It's not an equity in the traditional sense. Let's just carve out a separate section and call it, alternative." So we've seen all three ways used successfully.
And you know, we talked about it before, how markets now are moving quicker than ever, and it's a loser's game to try and time the market, especially now. And you just have to, you know, create an asset allocation, right, that fits your client's investment objectives, their profile, and stick with it long term. And make sure you talk about diversification. Well, diversification just isn't stocks, bonds, and foreign investments, right? You need alternatives, a hedge
Mhm.
strategy, so they can sleep well at night, right? Are there any misconceptions about hedged equity strategies?
Yeah, that's a great question, and I think we're certainly in a period where we have to address one of the main misconceptions, and that is this idea that hedged equity is only for bear markets. That the only time I would put hedged equity in there is if I know a bear market's coming. Well, I would contend with this. I mean, if you know a bear market's coming, then just put all your money in cash, right? But like you said, you don't know. It's hard to say with those market timing, and there's so many different things that could go right or wrong in the markets. It's very, very difficult to get those calls right. So the idea of just holding on to hedge equity only because it's a bear market, I would not think that that's the best way to use it. But yeah, the other thing to keep in mind is that hedge equity, right? I mean, yes, there's the hedge for the components, but there's also the equity components for up markets. So a good hedge equity strategy should capture a good portion of the up markets. It's not going to get all of the up markets. That's the trade-offs, but you still should get decent returns that anyone should be happy with if the market's up decently.
Great. Like while you were talking throughout this conversation, so many times I thought, well, there's no free lunch in this industry, right?
Yep.
But fantastic. And I think, with the evolution of investment portfolios and the way markets are now, and it started with the Yale Foundation endowment about how alternatives have to be such a big piece of investment portfolios, and the retail investor now they're starting to wake up to that, and hedge equity strategies, like you say, could be another alternative that helps reduce correlations, which is so important when creating an investment portfolio. So, moving along, something fun. Well, this topic has been fun. This conversation's been fun, but Marc, you are a alum of University of Washington. You are a Husky.
Indeed.
As
My
everyone,
purple on, got my purple shirt.
there you go. Well, I've got my red on for the W. And with college football going crazy with realignment, Washington and Wisconsin, they're going to be in the Big Ten together. So that begs the question, who is the real UW? Is it University of Wisconsin or University of Washington?
Well, I guess we'll find out. I mean, now that we'll be in the Big Ten, those will be bragging rights for the title of UW. Certainly, I'm happy with the way the season's going for my Huskies this year. I mean, we're a quarter way through the season, and the Dogs look very, very good. I got some tough games. Certainly, the Pac-10 looks or Pac-12, I should say, looks very, very tough this year. But that being said, I will admit I've always had a very soft spot in my heart for Wisconsin. I've been through Madison several times, and every time I've been there, it's like, this is a great town. I have so much fun when I'm in Madison, and there's different neighborhoods. But every neighborhood I've been in, it's like, this is great. I can see why people want to go to college here. It's a lot of fun.
Yeah, it is fun. I often joke, it's not really a joke. I didn't go to Madison. I was never smart enough to get into Madison, so I had to go somewhere else. But Washington's had a fantastic season so far, and they've had a good run, been in the college playoff a few years back. So they had some lean years, but I living in Seattle, I enjoy University of Washington and the Huskies also. I often root for them. I feel as if their stadium is second to none, right on Lake Washington. It is, people boat up to the stadium. It's absolutely fantastic. And I'm really upset that Wisconsin lost to your guys' big rival Wazoo a couple of weeks ago. I was like, are you serious?
Yeah.
But yeah, Wazoo should be tough too. And I think right now the biggest thing University of Wisconsin probably has on Washington right now in football is that we could probably outdrink most Huskies. So that's maybe the only thing that we have right now, but it'll be fun. I can't wait to maybe go up to Seattle and watch a Badger Husky game.
That'd be great.
So all right, Marc, thank you so much for coming on the show. It was really a lot of fun. You dropped a ton of insight on this subject, which I knew you would. So quickly, where can our audience get more information about Swan Global Investments?
Well, you kind of said it right there. Our website is swanglobalinvestments.com. Swan has been in the hedge equity business for over a quarter century. We started all the way back in 1997 writing strategies, actively managed hedge equity strategies similar to what we've talked about. And yeah, it's swanglobalinvestments.com. And it's funny, Ryan, I mean, lots of the things you talked about are things I've written about. I mean, one of the more recent blogs or white papers I put out, I called The Correlation Conundrum. And it's this thing I explore. It's like, look, it's not just when these periods of crisis happen. It goes all the way back to the global financial crisis 15 years ago. You can look at this 15-year period, and correlations throughout have been very, very high, which of course diminishes the value of diversification. So, and I can go into the reasons behind that. But yeah, there's lots of fun stuff to read on there. And yeah, again, thanks for having me on, and hopefully, welcome back, and you'll welcome me back sometime.
Definitely. We could schedule it now, Mark, next week.
Well, let's wait for the college season to end, and then we can see who's got the bragging rights.
There we go. There we go. Yeah, it was a lot of fun, and I cannot recommend your blog and your information enough. We still leverage a lot of your insight and content here at Zephyr. It's fantastic, fantastic reading, and very educational and insightful.
Thank you. It's very flattering. I appreciate it.
Yep. All right, Mark. Thank you so much for coming on the show. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our podcasts on the Adjusted for Risk YouTube channel, as well as on Spotify and iHeartRadio. Thank you, and have a great rest of your week.